Hello and welcome to the Lighthouse Wealth Management Quarterly Update. I'm Henry Becker, the Director of Research and Investment Strategy with Lighthouse Wealth Management. And what we have here in front of you is the words that are spoken, or that were spoken, at the beginning of the Twilight Zone television series from the 1950s and 60s by Rod Serling. It's our opinion that the financial markets are now in a twilight zone of their own, in the sense that we're in a altered reality. We don't necessarily think it's going to be a permanent one, but it is where we see the markets currently. So what we're going to do in this quarterly update is go into some of the details of the distortions or the suspended reality that we see in the markets. Why has it been so hard for responsible money managers to guide portfolios? Well, with that statement, we're not looking for sympathy, like, oh, poor us for having such difficult jobs, because many people have difficult jobs. But the suspended state of reality, the twilight zone that we are in financially, has really created a lot of problems for investment advisors, or quite frankly anybody trying to manage their own money. And the reason for that is we have so many distortions, things that just don't make sense, or that are turned inside out, like debt markets, like the currency wars, like productivity relative to the economy, interest rates, the stock market, and the dynamics in the precious metals markets. And we're going to touch on each of these individually in the rest of this presentation. So let's start with the debt market. What we have in this chart is, in the blue columns, we have interest on the federal debt, which is identified here on the left axis in billions of dollars. And the red line is the federal debt, and it's on the right axis in trillions, or sorry, billions, but since we're going in to the thousands category, it becomes trillions. So what we see is, since the year 2000, we were paying a little over $350 billion in interest on the debt. And today, or at the end of 2012, we're still paying a little over $350 billion on the federal debt. But the curious thing is, the federal debt has grown from, we'll call it a little under $6 trillion to over $16 trillion. Now, that is more than a doubling of the debt in a 12-year period, yet the debt service has remained level. At the same time, we've strangely been able to, in the United States, maintain our credit rating in the meantime. I guess the credit rating agencies like Moody's and S&P and Fitch and so forth have turned a blind eye to the fact that the ability to service such debt is predicated on the Federal Reserve holding interest rates next to nothing. In many of our writings here at Lighthouse, as well as other presentations, we've pointed to the currency war that's going on, where you have competitive devaluations of currencies. This is just one aspect of the currency markets. The other few things are negative real interest rates, meaning if what you can earn at a bank is, well, like right now, next to nothing, we'll say 0%, yet inflation is running at, we'll call it, this consumer price index is showing it roughly 2%, but in reality, inflation is probably closer to like 6 to 7%. But what we see is all of these countries are in this list, in the G7, in the Eurozone, and other countries. These are all countries operating under negative real rates of return, which is basically a silent thief, in the sense that if you have money parked in conservative investments in banks and most types of short to medium term sovereign bonds, you're losing money to inflation. Then we have the quantitative easers. These are the money printers, the US, the UK, Japan, Eurozone, Switzerland. And then the manipulators or interventionists. These are the countries that either outright manipulate their currencies or, when I say manipulate, meaning they push down their currencies, they sell their currencies or buy their currencies in volume to move their exchange rate around relative to the US or the dollar or the euro. So this dynamic that you see in this chart is historically, as far back as history can possibly go, unprecedented. So next we're going to talk about productivity. An economy grows one of two ways, or two of them can happen at the same time, where you have either a population growth or increased productivity. Hopefully you have, most economies are looking for both. In this first chart, what we're looking at is the civilian employment to population ratio, which is essentially how many people, what percent of people are employed relative to the population. So what we see is today we're sitting at roughly a little over 58%, and we have the same amount back in 1984. And since then we've climbed some mountains and come down. And it seems like we're stuck here at this 58% ratio. And I say stuck because the population is not growing that fast, and the number of people employed are not growing either. So this is not a good place for increasing productivity when you have an employment to population ratio like this. In our next chart, what we're looking at is the change in the number of jobs since 2009. These are leisure and hospitality, education and health services, temporary jobs, retail, trade. This is where the bulk of jobs have been created since the quote-unquote recovery in the economy since 2009. These are not highly productive jobs. These are more service-oriented jobs. We're not creating things. We're changing the paint color on somebody's car. We're tending to healthcare needs. We're selling goods to people. This isn't production, which is what the U.S. economy was 50 or 60 years ago, but what it is not today. This little chart, restaurant and bar employees relative to manufacturing employees since the year 2000. As you can see, the blue line is the number of restaurant and bar jobs, and the red line is the number of manufacturing jobs. And in our last chart, we have the percentage of SNAP, which is food stamp program. The percentage increase since 2009 in the number of food stamp participants is the blue line, up more than 45%. And the number of jobs, non-farm payroll jobs added as a percent, which is almost negligible, roughly 2 to 3%. So in terms of productivity, it's hard to imagine that the U.S. Economy is highly productive. Yet the stock market, not just in the U.S., but global stock markets, have done very well in light of such really poor economic background. Interest rates. As we all know, interest rates are pretty much at zero. Interest rates are a red line in this chart. And then we have the blue lines, which is the stock market. And we reside up here in the rarefied air of over 1,500 on the S&P 500. We've seen this point roughly 3 times before. And interest rates, we've never seen interest rates this low before. So we have a huge disparity between all-time highs in stock markets, all-time lows in interest rates. One's fueling the other. Continued zero interest rates are creating large amounts of distortions in the market. You might just say that the zero interest rate policy is what's fueling the distortions globally. And as you can see in this chart, when the economy is hit difficulty in 2000 and 2008, the stock markets fall, interest rates are lowered. In the past, we've seen interest rates rise as the market and the economy recover. But in the most recent recovery of the stock market, we've seen interest rates not move, and the economy really hasn't progressed either. That's why we're still at zero interest rates. No matter what the president or the Fed or whomever might say that the economy is making modest gains, we find those modest gains are few and far between. And that is why we're still at zero interest rates. Stock markets. In the past, I've mentioned that stock markets float on the global economy, or float on the global economic ocean. In this chart, what you see is the quarterly change in global gross domestic product, or GDP. So what you can see, the purple line is the total of the G20. The G20 is the largest, pretty much the largest, most important nations on the planet. The U.S., Germany, France, the UK, China, India, Brazil, so forth. The blue bars are the BRICS, which is Brazil, Russia, India, China, South Africa. The red bars, the rest of the emerging market world. And the green bars you hardly see are the developed economies. We're not adding a lot to the growth of the global economy. It's really the emerging markets that are adding. And even at that, countries like China more than likely are fibbing on their gross domestic product growth rates. But the reality is we see a downward slope, but the stock market looks the opposite, and that divergence isn't normal and really, quite frankly, is not sustainable. And then in this chart, what we see is if we look at both interest rates, bonds, and stocks on one chart, going back to 1990, we can see the peaks and valleys, the red line in stocks. We can see the steady move up in bonds as interest rates have been slowly declined to zero. So stocks and bonds have benefited greatly from the zero interest rate, or not, the decline to zero interest rates. So for us, the question is, what happens when there's a reversion? That reversion is going to, reversion in interest rates, that is, to an average point or an average rate. That movement to the averages is more than likely not going to be a positive for stocks and bonds. Lastly, we're going to talk about precious metals and the disconnect here. U.S. Mint suspends some gold coin sales after demand surges. Gold rush from Dubai to Turkey saps supply as premiums jump. Central banks net buyers of gold for the first time in 20 years. Trust in gold, not Bernanke, as U.S. states promote bullion. Chinese gold imports in 2012 in the blue lines, monthly, and then in the red lines. It's abundantly clear from the headlines and from China that gold is in demand, and in great demand, especially in the physical sense, not exchange-traded funds or futures contracts and those types of things. Physical precious metals are in high demand. And from a supply standpoint, the supply is no more, quite frankly, it's harder and harder to find good supplies of gold. Yet the prices have been declining rapidly. And in our opinion, that is a major disconnect. And that disconnect is a result of, and again, in our opinion, that the price of the precious metals are being managed or manipulated, whatever you want to say, because countries have been printing money like crazy, destroying their currencies. And the telltale sign historically of such things have been surging precious metal prices. So to keep people using the current fiat money system that the globe uses, the price of gold has to be managed. They can't just let it run away, or it'll become abundantly clear that that currencies are being destroyed. So in summary, markets are in a suspended reality. Hedging risk is prudent. Central banks are steering the markets. Markets are still optimistic that central banks are going to be able to pass the market back to normal without disruption. And looking for risk-adjusted upside with a close eye on the exits is very practical at this point. The bottom line of these points in the summary is that we are in this financial twilight zone where things, supply and demand aren't really they work, but they're being trumped in the commodities market. We're looking at interest rates being suppressed now for multiple years, which distorts the pricing for things like bonds. And it also distorts the stock market because it pushes people into risk assets that they normally wouldn't be in. So for us, we want, while this is unfolding, we want to still grow client portfolios, but at the same time, we don't want it to be pushing the risk envelope with clients because the dangers are very real that the central banks are not going to be able to pull back from all this accommodation they've provided without disrupting the market. And market disruptions at this point, because people are very sensitive, investors are very sensitive, can turn on a dime, and the markets can go, instead of 3, 4, 5 years up, it can go down and erase those gains in literally a matter of days. So we think caution is the name of the game. Lastly, we're going to go through a Q&A, question and answers. Over the last few months, we've gotten quite a few of the same questions from clients, so we thought we'd share them with the broad client base, just so if somebody else has the same questions, we can provide answers. So one question was, what's going on with bonds? And very simply, it's just to say interest rates. As interest rates rise, the value of bonds typically fall. And the reason for that is it's like a seesaw. If I'm holding a bond that pays 2% and new bonds are paying 3%, well, my current 2% loses value because nobody's going to really want it. They're going to want the higher rate. So the opposite is true if rates are falling. If I'm holding a 2% bond and new ones are issued at 1%, well, then my 2% is worth a lot more now because it's paying a higher rate. So with rates rising, we're seeing bonds and bond funds losing value. And that leads to the second question, which is, what is our interest rate outlook? The Fed is set on interest rates, as we've talked about earlier in this presentation, for a long time in the hope that the economy would recover, to give it time to recover. Even though the recovery's been slow at best, it's unlikely that the Fed is going to now just all of a sudden let the market dictate interest rates as it's supposed to, because that would certainly derail the slow economic recovery. So our interest rate outlook is we're likely not to revisit the bottoms in interest rates where the 10-year U.S. Treasury note was, we'll say, 1.4%, currently at roughly 2.5%. We're likely to hold in this area between 2 and 2.5%. Rates could get as high as 3% on the 10-year, possibly, but it's unlikely, again, that the Fed's going to let rates get too high and push back on the economy. And the last question, do we see cash or money market as an asset class? And the answer is yes and no. Yes, in short term, when there's volatility in the market, when there's not really good entry points, cash is a perfectly fine, or money market's a perfectly fine place to park money in the short term. The no side of the answer is long term, we don't really view it as an asset class, especially where we have negative real interest rates. So for us, we use cash or money market opportunistically as a parking place while we're looking for opportunities to invest money. Sometimes those opportunities are for a few days, weeks, months. Could be as long as a year. In periods like 2008 and 2009, when the market was just steadily declining, most people were happy to be sitting in cash versus losing money in stocks and bonds and other things. So without being flippant, the answer to that last question is yes and no. So hopefully in our presentation today, you got a sense of why it is becoming really difficult for everyone, money managers and non-money managers, to navigate this financial twilight zone, because it's just, when you look at data points, when you look at the qualitative things, other than the Fed printing money, or the European Central Bank or the Japanese Central Bank, there's just not a lot of indicators that say you should take risk. It's all screaming the opposite, quite frankly. So for us, we take a measured approach to risk. We're very cautious with client money at this point. So again, hopefully you've enjoyed the presentation. If you have further questions or comments, please feel free to drop us an email or a phone call. Thanks again for your attention and your time.